Indicators, they are technical analysis tools used to forecast the market, trend, and sentiment. So they are classified based on their time of reaction or nature. Now, it's very important to know every time you have an indicator, you place that indicator in your chart. It's very important to know what this indicator is made of. So you choose on your indicator based on how long do you want that indicator to express the trend or the sentiment. If you do you want it to take a few times, do you want your indicator to react right away? And some indicators, they are classified based on their nature, because not, for an example, not every indicator consider the price, not every indicator consider the sentiment, the momentum of the market. It really depends on how this indicator have been built. Now, it's important to understand the nature indicator, because the sets of indicator you're going to use to place in your chart really going to depends on your trading style, the trend, and especially based on your affinity. Because if you're using a shorting system, they offer thousands of indicators, but you can choose, once you know how to classify them properly, you choose based on the one that you can learn the best. It's important that you master that indicator. You don't put an indicator in a chart just because someone else is using it. You're supposed to select one based on what works the best for you. So now, based on time of reaction, you have indicators that consider lagging indicator, and then you have indicators that are considered coincident indicator, leading indicator. You have an event E in the market, crazy. So you have an event, and then you have the time it takes for that event to express in the market. So some indicators, they react right away. So we can say they react in the moment. So you can call them coincident indicator, some are lagging indicator, and then some of them, they allow you to anticipate what's going on, to anticipate expected reaction. So when you're gonna select your indicator, really depends on the trading style you have. For an example, some, if you are, I'm not a, I mean, I used to scalp, but scalpers and day traders, they are not really into lagging indicators. Lagging indicators are more for swing and long-term plays, but really some traders, they literally choose them based on what they are looking for in that particular indicator. Because what happened is that um, you can use an indicator even if we are using the same indicator, but based on what you are looking for, based on what you are uh, looking for in the market, that indicator can be used for different reasons. All right. Now, a lagging indicator is an indicator that reacts to an event after it occurs. Now, despite the lagging characteristic, it can be useful tools because of trend tends to persist. It can help confirm a trend that is in progress. For an example, um, we have moving average. That's a lagging indicator. You have Bollinger Bands, lagging indicator, and MACD. Now, one that we can use, one example as a general example overall, is the unemployment rate. So what happened is that, like I said, you have an event, and then you have the time of reaction. Now, those indicators, for an example, I know that moving averages, they are, for an example, that's a set of moving average I like to use. I use especially the exponential moving average. Now, the way that they are built is that, for an example, if you're using a 20 moving average, they take the 20 last sets of time. For an example, if every single one of these candle are daily, so they take the last 20. If you're using the 20, but for an example, they take the last one, and then they take the average price of each of them, and then that average give a point for every single last of time, and then when they join those points, you get a line. Now, that's the way that the moving average is built. But the thing here is that if this candle is, for an example, everyone is a day, every candle represent a day. You gotta have to wait for like 24 hours for the next point to be available. That's the lagging behavior of that particular indicator. I used to use Bollinger Band a lot at, when I first started trading, but not really into it. I still remember a few things about it, but maybe we're gonna have to talk about this another time. Now, this is an indicator that I use a lot, the moving average conversion diversion, and that's not a lagging indicator. Every single one of these um, on the histogram, that's the histogram right there. Every single one of them, they literally take the exact same time as the candle um, for every one of them. So um, now, like I said, the lagging indicator is not suitable for low time frame trading style. Now that would be an example. That's Ethereum 2018. This candle was there. These two candle were there. They are I think they are like November, December. And for an example, that would be a MACD crossover. Now, if you're using the MACD as a buying and selling signal, the lagging behavior of the MACD is a little bit too strong, especially for low time frame trading style. So, for an example, the bear market start in 2018 on Ethereum around November and December, and it literally takes 42 days to have a crossover. Now, from a swing trading or uh, perspective, I can use this to confirm a trend, eventually look for a short somewhere here, but the market would be like 42 days already deep in the bear market. So that behavior is the same thing for almost every single uh, time frame. If you're using MACD for entry signal and selling, buying and selling signal, that's not the best. Most traders that are trading in using time frame that require low time frame, like scalpers and day traders, they are more into momentum indicator that we're gonna talk about them. So that's another one. The coincident indicator, it's an indicator that react in live to the market, can be used to analyze an event as it occur. Now, RSI is my go-to when it comes to coincident indicator. I am used to Keltner channel, but I don't really use it anymore. So the other example for the general economy would be the GDP. Now, what happened is that these indicators they change their expression in real time. So they pick up data in real time, and then they change their expression, and you can see it happen right away. That would be a big difference between RSI and moving average, for an example. Now that's an example of an RSI on Neo USD dollar. That's the Keltner channel, and let's go ahead and move on with the leading indicator now. A leading indicator is an indicator that allows the technical analysis to anticipate the market, points toward possible upcoming situation. Now, the keyword here is possible. So the leading indicator, for an example, trend line, support, resistance, channel, and then this is interesting, and that's one of the reasons why I always recommend RSI, because RSI tend to have many aspects on its expression, and I'm gonna show you how this is present. Now, another example would be our start and lipstick indicators. You can make research about them. Um, so these indicator possible upcoming. Now, what happened is that um, when you use those indicators, for an example, that would be an example of support and resistance, and that chart is EOS US dollar. That I think that's weekly or monthly time frame. Now, the leading indicator allows you to have a view of event that might happen with a sense of odd ratio. For an example, once you have two touches on a support, for an example, you can call it a potential support. The third one is a confirmation. Now, when we're gonna make it to that level again, then you can expect a reaction. The reaction is like 85-25% or 80-20%. So you have like 80% probability to have a bounce off of this. Now that will give you opportunity to take a trade. Really depends on the overall market trend. Now, if this is a bull trend, this is a long possibility. A bear market, that will be a different things. So you can anticipate what's gonna happen. That, for me, it allows you to expect what you can get from that, um, what's gonna happen as a profit. But the thing is that it also allow you to make peace with the potential loss, because if you're gonna place a long position somewhere here, you know that you're gonna have to place a stop loss somewhere here. Now, the idea that you get, um, like I like to say it, you make peace with the loss. You make sure that you know how much you're willing to risk, and if something goes wrong, I know, for an example, if it's a bull market, you have 80% possibility that it bounce. But if it doesn't, then you know that you are willing to take this loss, and you already set your mind psychologically to accept this one. Now, um, yeah, okay. Yeah. So that would be another example for every, that's a downtrend line, and three touches, that would be a confirmed downtrend line, and then we have a break here, and then really depends on what is the overall trend of the market. You will have to make decision based on that. Now the other thing, now that would be the leading behavior of RSI. I wanted to show you this one, guys. Now RSI, in addition to be coincident, can also help you um, forecast or anticipate reaction. For an example, that's a downtrend line on RSI. Now, one of the interesting thing about RSI is that RSI is one of those rare indicators in which you can do indicator inside indicator. So traders, they place trend line, support resistance inside RSI. They also use the Fibonacci inside RSI. They use channel, all those kind of, most of the technical analysis figure that you can apply on a candlestick. You will see some experienced trader use them on RSI. Now that makes RSI the type of indicator that can be used as coincident. Very different because wait a minute. Sure. So those two figures, they look alike. They really look alike, but they are very different. For because RSI do not consider the price action. So RSI is mainly monitoring the sentiment, the overall sentiment of the market. In the difference here, you can have it in the candlestick. Now, when we got a close here, when the downtrend line have been broken at that level, we tested on a rebounds. So the bullish sentiment is still there. So for me, that will be an indication to enter long. If this is a bull, an overall bull trend, that will be for me an indication to enter a long position. Now, the second classification is based on the nature of their reaction or the reason of the reaction. Now, some indicators, they react to price action, and some indicators, they react to momentum indication. Now, it's very important because some indicator in their algorithm, in the way that they've been built, they pick data from the price overall, the sets of price over a certain period of time, and then they give you an expression. But and then you have a momentum that essentially make present you the market by considering the relationship between offer and demand. Now, a price action indicator, like I always said it, the behavior of this indicator essentially react to the price of the chart, often independently from the relationship between supply and demand. Now, this thing is a little bit, it was confusing to me because before I understand that, I thought that every indicators they were um they were all about the candlestick, but not some of them does. Some of them they consider price, some don't. For an example, on price action indicator, you have moving average, Bollinger Band, and Kirtland channel. Now, and then you have the momentum indicators. A momentum indicator essentially react to the supply and demand ratio. Like I said, the value of a momentum indicator often can affect the price, but the inverse is not always true. Now, RSI, MACD, and another one that they call ROC, but I'm more familiar to these two ones. RSI and MACD, they react to relationship, the ratio supply and demand. Okay, so you have in when you are using momentum indicator, there's situation of overbought and oversold. Now, lots of traders, especially new traders, they use that as a signal, which is not the right way to do it. For an example, an overbought situation is when the price of a trade instrument is often is overvalued in a that is an example of RSI. Now, for most people that are using it, the common knowledge about RSI is that this zone right there will be considered as overbought, and this zone right there that will be considered as oversold. Now let's go over the text, and it happens. An overbought situation happen a lot in the bull market. So as you can see it there, you have lots of overbought situation. Now some people will say that these are selling signal now, or these are situation in which you have to short. But the thing is that it's all depend on the overall trend. Now what people don't get is that at every moment in the market there's always three possibility. It's either we go up, it's either we go down, or it's either we go sideways. Now the market generally spend between 50 to 70% of its time sideways. Now if you see this, if you pay attention to this movement, that's like one full year of trading, well, you realize that most of the time we're trading in a range. So in almost every market they are the same. uh like most instrument or asset, they make a move whether up and down, and then they spend on lots of time like in a range. So the LSI and like most indicators, they can only express two things. So when they get a situation in which you have a consolidation, those signals they tend to be confused, and that's the reason why the overall trend is important. Because if you go ahead and short this, or sell, that will be a bad decision. It's all about the trend. That is probably this shot right there was the 2017 bull market of cryptocurrency. So in a bull market, those overbought situation they happen a lot. Now, what's important is that, um, like I said, these are not indication to short, because in a bull market I never short. Just like in the bear market, I never go long. In a bear market, an overbought situation can be an amazing opportunity to enter a short after using other indicator to make your confirmation. Now, momentum indicator concept, you have also oversold situation. Now, an oversold situation is when uh, the indicator is telling you that the instrument is under evaluated. Now, that would be a bear market like 2015 Bitcoin bear market. In a bear market, you realize that oversold situations are more common. They happen a lot. Now, over both situations, they are rare. Now, in a bear market, these are short opportunity. So you would have wait for a bear rally and look for a setup in 4 hour, 1 hour time frame to look for a reason to short. Now these are shorting opportunities. Now if you see an oversold situation in a bull market, okay, it can be a big opportunity to buy. Let's go back on this. Now, this an entire bull market right there, as you can see, oversold situation are almost inexistent. The bull do not let enough supply to push the RSI all the way down to an oversold situation. Just like in a bear market, the bear do not let the bull enough time to push the demand high enough to keep the market overbought. And that's the reason why those rare situation, they create a big trading opportunity, big swing opportunity. Now, one more thing, in a bull market, in a major bull market, the market is more sensitive to oversold. Like I said, they are aware, and when you see them, you need to study them properly because they are swing opportunity. So they are temporary change of the trend, and when associated with other analysis tool, they can traders can use them as awesome buying opportunity, and that will be in a bull trend. Okay, so not every oversold means you should buy, and not every overbought situation means you should sell. Okay, a bull market can stay overbought for a very long period of time, and I think I'll show you that. I'll show you that here. Okay, so in a bull market, these happen a lot, you know. So usually I use them to reduce long position in bull market. In in a bear market, the oversold situation happen a lot, and I use them to reduce my position, short position. So for an example, if I have a open short, I might use I might reduce it by 25 or 30%. Really depends on what I think is important to take a small profit. Now, in major bear trend, the market is more sensitive to overbought situation. Like I said, so you find them, you can short a bear rally. Now, I put that in. I make this very important because wait, give me a minute. People asking question. I might take question after that, so I'll take question after that. So a difference between bear rally and bull run. Now, when you see I think that was confused for me a little bit. Now, a bear rally is something that you see only in a bear market. A bull run is something that you see only in a bull market. Now, the thing is that every time you have higher highs, for an example, this situation right there, like you have higher highs, you can say, well, that's a bull trend, and you have those surge of price. Now, these surges of price, they can happen in any given market, bull or bear market. So you can have those price, you have them, but these are called bear rallies, and these are called bull runs. So it's the same situation of price going up, but bear rallies, when they create overbought situation, they are shorting opportunity. In a bull market, bull run, which is literally the same thing, they are not shorting opportunities. You're not supposed to short at all. That's what I said. I don't short. I don't short in bull market. So the other thing is the other thing about this presentation is diversions. Now, it's a term that many people use, and there's it's very all you're supposed to understand is that when the price action and the momentum interpretation are in conflict, this is called diversions. Now you have bullish diversion, bearish diversions, and then all you need to understand is that not every orders that are being executed in the market are real orders. There's lots of financial contingency in those transactions when they are happening. For an example, if you open a trade, let's say that you paid you have an account of $100,000, and then you can leverage up to 5 times. up to $500,000 down. Now, when you take this trade, those trades are being posted as demand. Let's say that you take a long. That trade is posted as demand. And when you're about to close this position, the exchange and the overall market regulation will pass you through a set of contingency in which you're gonna have to pay, the fee and the price you pay to maintain the position open, all this kind of thing. Now, that those financial contingency, they influence the price, but they do not influence the relationship between demand and supply. And that's the reason why you have those diversions. So those sets of regulation that you have to go through to close, because there's different type of trading style and there's different type of trading in general that literally influence the price. Like you have derivative and margin trading and this kind of thing. And then when you're making those um, transaction, they influence the price, but the asset in itself, the supply available in the market won't change. So the balance between supply and demand, those transactions, the force between bulls and bear, the momentum indicator do not consider the price. So all those transactions can spike up the price, but not really the relationship between supply and demand. And that's the reason why sometimes you have those, what they call them, diversion. Now, somehow a set of transaction push the price all the way down, but Ethereum in itself, it's like RSI is clearly telling you that even if the price is going down, it doesn't really match the supply being dumped in the market. So that will be that is what is a diversion. So even if diversion, they have the same mechanism, they mean different things based on what is the major trend. So you can have the same presentation in the bear market and you have the same presentation in the bull market. You literally have to trade these things differently, because in this situation, if this is a bull market, this is a buying opportunity. But if this is a bear market, for an example, I have this diversion, this bullish diversion, I might reduce a short position if I had one that was open, but I'm not gonna open a long position if this is a bear market. So it's always important to go and adapt your trading. Doesn't matter what is your trading style, you literally have to adapt your action based on the major trend, because that's how people blow up their account. Now, some principle about indicator, you need to take the time to understand your indicator for many reasons. That makes you more stable overall in your trading style because you know what the indicator is made of. So, as I said, your trading style will influence the way you use them. And honestly, I don't think you're supposed to have more than 4 different indicators in your currency chart. Now, by this, I mean you can have 5 moving average. That's not 5 different indicators. You're just using moving average because uh some trading style you use different sets of moving averages, and then how they cross over, and when they cross over they might mean something for you in terms of trend or sentiment. So that will be one indicator. I know some trading style in which you can use two MACDs, but you have to change the input. I know some traders, they use two RSI. That will be considered as one indicator. So having more than 4 different, it's not, you won't need that. Sorry. So just to make a recap, now if you're building your trading strategy, I think you need the momentum anyway. You're gonna need a momentum indicator anyway. Okay. Now it's not good to choose indicators that literally doing the exact same thing. See, for an example, if you're new to technical analysis, you posting charts and everything, traders that are experienced, when they see your chart, the first thing they go is your sets. They go through your sets of indicator. They know that oh, he's using like two lagging indicator as his way to confirm a trend. So this kind of things technical analysis, they pick them up and they kind of know your age, your technical analysis age, if I can say it like that. So momentum indicators, big time, especially when you're moving on low time frame, extremely important. And then lagging indicators, mainly to confirm and leading, anticipate, and coincident moment. How you monitor the market trend in real time. So now that would be an example of how these are the only indicator I use personally. Now I am familiar with many different one, but that's my usual setup. I have a sets of exponential moving average. I have my LSI, and then I put my MACD here. Okay, and I don't think I had anything else. Let me go ahead and check the chat.